So imagine you have this time and price axis. Um, at certain time in the past, you bought a stock. Okay. So at time t equals 0, the stock price was S0. Some time has passed, right? Okay. Right now you're at time small t. The stock price has evolved. The stock price has evolved from S0 to ST. It has taken some path. That path is the historical evolution. Okay, it's in the black line. Nobody can change history. Correct. History is there. It's cast in the stone. You cannot change the history. But that information is available to you. So you're standing at time small t. The price of the stock is ST. All right. What you're thinking is, as I mentioned, this is history, and then the current position is at time t. At this moment, you're thinking, what will happen at time t plus delta t? So, sometime in the future, at time t plus delta t, what will be the price of the stock? Nobody knows the future. Everybody knows the past. Nobody knows the future. Only God knows the future. So, how do we determine the value of the stock price at time t plus delta t? If the stock price goes up, then you have a profit, right? So, delta S is ST plus delta t minus ST. If the new price is higher than the old price, then you have a profit. If the new stock price is lower than ST, then you have a loss. Correct? So we understand profit and loss. So I'm saying PNL, profit and loss together, is equal to delta S, which is the new stock price minus the old stock price. PNL is one term that combines both profit and loss. Okay. Now, depending on whether your return is positive tomorrow or negative tomorrow, you'll have profit or loss. It's one variable return, or you can say ST plus delta T, that determines whether you have a profit or a loss. So together, I'm calling that variable, which is change in S, as your PNL. All right. Now, PNL is uncertain. Nobody knows tomorrow whether you'll have a profit or loss. Nobody knows. Okay. Risk is defined as uncertain loss. Okay, it's a loss that is uncertain or random. You don't know exactly how much the loss or profit would be. Uncertainty is the key thing that has to be modeled. Okay. Right. So next question is how to measure risk. You don't want to be in the dark, right? You want to have some kind of modelability or idea of what ST plus delta T tomorrow can become. Okay. How do we measure risk? Fit a distribution. All right. So we need to fit some kind of distribution. If we know the distribution, then we can measure a lot of things and prepare ourselves. Okay. And this is not something new. We actually do it subconsciously. Simple example. When you're making some travel plans tomorrow, let's say it's holiday season, you're thinking of traveling somewhere. And one thing that impacts your traveling plan is the weather tomorrow. Correct. What will be the weather tomorrow? Exactly, nobody knows. But yes, you have predictions, whether very accurate forecast of weather that is available to you. They also use all kinds of models. Let's the weather forecast has this kind of a report. Tomorrow, the chance of rain is 10%, no rain is 90%. This is a distribution, right? What kind of distribution is this? Let me ask you. Rain versus no rain. What kind of distribution it is? Please participate. Not exactly binomial. Even before binomial, what do we have? Bernoulli is success failure, one trial. Tomorrow is one day, right? Whether it will be a success or failure, rain or no rain. That's a Bernoulli random. So it's a distribution, right? To make decisions, we need distributions. It's nothing new. If the forecast is like this, tomorrow rain will, chances of rain is 10%, no rain is 90%, then probably you don't need to prepare anything. It's only 10%. But let's say the forecast is rain, chances of rain is like 75%. Then you'll take an umbrella with you or raincoat, something like that. That is risk management, right? We need a distribution to act. So similarly, stock price tomorrow, what can it become? We need a distribution. Once you fit a distribution, we can calculate all sorts of things. We can calculate value at risk, expected shortfall, any other market risk measure that we want. Okay, so I'm just giving you the big picture so that you understand the context. Otherwise, if you start with the formulas, right, it's very easy for you to get lost and lose the big picture. That is a strictly no. So you need to understand why we need something, so where we are heading, and then you go down deeper and then get to the formulas. I hope this picture is clear. Let me know any question, if any questions. Okay. All right. So now what? I'm taking the initial part a little bit slow, and then it'll be a lot of maths coming in. Next question is, what about the horizon delta t? So you're talking about stock price in the future, that is after time delta t from now. How big is delta t? Is it 1 day, 10 days, 1 year? What is it? Before we get there, you need to understand a key aspect of uncertainty, which is linked with the horizon. It's common sense. If you allow only a small time, then the new stock price will be close to the current stock price. It will hover around the ST, correct? But if you allow a lot of time, so you're thinking of stock price after 30 days, it can have huge swings, right? Upward, downward. So what I'm trying to say is, if delta t is small, then the distribution is very narrow in the sense that it is very concentrated. You can look at the picture. Right? The distribution is concentrated around ST. How much can change in 1 day? I mean, stock prices have crashed in 1 day. That's a different story. But the idea is lower the horizon, time horizon, more concentrated will be the distribution, lower the loss potential. If you have a much bigger delta t, then you have a more dispersed distribution, which means the extreme values, higher and lower, are more likely. Okay, as opposed to the narrow distribution where, look at this density, at the extreme values, the density is very low, but when you increase the delta t, you can see the density has increased, right? So extreme values are more likely. So this is an important intuition that you need to have. Okay. How to choose the right delta t? So for risk management, we want to figure out the distribution for the future stock price. But how far into the future we should look at? Should it be 1 day or 10 days or 30 days? What do you think is the right approach for this? Any ideas? Just randomly, feel free to comment something. Okay, Dia says 10 days, 1 year, 90 days. Okay. The idea is, think logically. Depends on riskiness. Yes, I like that. Okay. It depends on the appropriate liquidity horizon, which basically means uh, to so in future when the stock price goes down, you cannot just sit and watch, right? You have the flexibility to sell it. You are not supposed to, I mean, nobody is saying, hey, you bear the loss, continue suffering the loss for days and days. You don't have to do that. You can all you can sell it. So how quickly you can get out of the position? That defines your loss potential, right? If I can quickly get out of my position in one day, then I have to only worry about one day. How much can the stock fall in one day? That is what I have to worry about. Because I know if it falls large enough, I will sell it and get out of it. And the ability to sell depends on the liquidity horizon. Okay. So higher the liquidity, you can sell immediately, let's say within 5 days. Lower the liquidity, let's say think of real estate. Okay, so which are highly, less liquid. So for less liquid assets, you need a bigger time horizon to prepare yourself. So that defines what the delta t should be. Now we are doing this workshop agnostic of regulations. Okay, I don't want to impose Basel 3 or FRTV in this session. Just keep a free mind. You are doing market risk in a very original way, what you're supposed to do as a modeler. Okay. The regulatory focused workshop we have, that's the second one. There will focus in detail about the Basel 3 regulations and do regulatory focused calculations. In this session, it is just general market risk. Okay. Regulators, so just to give a quick background, delta T used to be 10 days for everything. Delta T used to be 10 days for every asset class. But with FRTB, they have given a taxonomy. Depending on the liquidity of the asset, the delta T or the horizon would be different. Right? Liquidity horizon. Exactly. All right. My objective is that all of these ingredients of market risk should come to you naturally. Why we are doing something, that should come to you naturally so that you don't have to memorize. I hope it is clear till this point. Right, for our calculation, we'll assume delta t is equal to 1 day, and then we'll see how we can enhance the calculations to accommodate longer time horizons later. Okay, we'll do that a little later. For now, assume 1 day. All right, next question. Okay, we finally found out that if we get a distribution, that means possible values of future stock price, we can measure risk. What should we model as the random variable in this case? Okay, if you want to fit a distribution for what? Or some random variable, right? What is the random variable here? You have some choices. The choices are stock price itself, change in stock price, delta S as a random variable. And here is another kind of change, which is a relative change. So the names are this. S is the level. You can directly model S if you want. Or you can model change in S. That is called absolute change in. It's called absolute change. Or you can model the relative change, which is change in S divided by original S. Okay, that's a relative shock. So you have these choices. Can you tell me which are acceptable for stock price or normally used? If you look at the market risk methodology document, the random variable that will be modeled typically is which one? For stock price. Okay, wait, there's a lot of questions. Let me look at it. Change in stock price, absolute change, relative change. Okay, there's a mixed bag. From a modeling perspective, typically we look at quantities which are stationary. It is easy because you can use entire time series infrastructure to model something. So we look at stationary variables. All right. For stock price, absolute change in S is not modeled. All right, because when the initially 10 years ago, the changes would be of the order of, let's say, $10 plus minus. Now the stock price has become huge, and every day the change is of the order of plus minus 200. Okay, so if you look at historical delta S is not representative of current delta S. That is the problem. However, if you take the relative change, which we call as, in this case, it will be arithmetic returns. They are stationary. 2% is 2%. Minus 3% is minus 3%. In the history, current or future, right? So those are stationary quantities. So for equities and commodity prices and FX, these three are similar quantities. We take the relative change or the returns as the target variable for which we need to fit the distribution. Okay, and all of these are related. So once you fix a distribution for this, you can figure this out. You can also figure this out. Not a problem. Uh, you can model S directly also. We use something called as geometric Brownian process. But for as far as market risk is concerned, you only focus on the returns. Okay, everywhere. So as I said, please remember, equity, FX, commodity. For these three asset classes, we use relative change or returns. Yeah, and for fixed income, which deals with interest rates, right? The interest rate would be the key underlier. There we model delta R, which is the absolute change. All right. So keep that in mind. Okay. Right now in the equity world, so our focus would be this one. All right. So we have chosen that we will model the relative return R equal delta S by S as our random variable. So how to fit a distribution? See, tomorrow's return will define the tomorrow stock price. All right. Okay. So how do we fit a distribution for R? Okay, I see a lot of questions coming. If I don't answer your question, probably it requires a long discussion. We can take it offline. So ping me after the session if I'm not answering your question at the moment. All right. Do not think that I'm ignoring you. Okay. So next question is, we found identified the target variable. Now, how do we fit a distribution for R? There are three approaches. So all the time we hear about these historical value at risk, Monte Carlo value at risk, and parametric value at risk. These things are it should come to you naturally. Okay, so that is my target. So how do we fit a distribution for R? That is the question. The first approach is historical approach. Historical approach, I like to call it as copy paste method. You copy from the history and you paste in the future. That's it. So what does this mean, copy paste method? Well, the idea is obtain the returns looking at the history. So this stock price, what are the kinds of returns that I have seen in the history? So delta S by S values over a historical window. Could be 1 year, could be 2 year. You just look back and see what are the kinds of returns that have happened over a 1 day time horizon. And then you assume that the future return comes from that same empirical distribution, which means whatever has happened in the past is what is likely to happen in the future. So my future distribution, or the kinds of returns that can happen tomorrow, is exactly how it has happened in the past. Copy paste, copy from the history, paste in the future. So what you need to do is look at the history, some suitable time window, could be 250 business days, which is 1 year or even beyond. Whatever is representative of all possible values of R returns. So you look at that, fit a histogram or a distribution, Empirical distribution. There is no formula for this. This is the main difference. We are not saying it follows normal distribution or anything. This is exactly how they have occurred in the past. So you can fit a histogram. This is the empirical distribution. And then you take it and paste it as tomorrow's returns distribution. All right. That's the idea. That is called historical approach. And the stock price tomorrow is linked to that return. Once you have a return chosen from the distribution, just plug it in here and you have the value for the stock price tomorrow. That's it. That is called historical approach. All right. Let me know if any questions. The next one is parametric approach. When you hear the word parametric, it means there are some kind of model parameters or curve parameters. Parameters means theta, mu, sigma, alpha, beta, all these things would be there. Also called as variance covariance method. Okay, why it is called variance covariance, I'll show you a little later. Question is, can we apply historical simulation to nonlinear instruments? Absolutely. In fact, historical simulation is the most popular method in banks. Um, all right. So talking about parametric approach. Right. When you see the word parametric means it involves parameters. Where does these parameters come from? So here's the idea. So what you need to do is assume returns follow some kind of a known distribution. Okay. This is a big assumption. That's the primary source of model risk. So we'll talk about model risk, model validation, backtesting, everything tomorrow. Anything that you assume needs to be validated, basically. That's what model validation is. If you assume returns follow normal distribution, then you have to validate that actually they follow normal distribution through statistical tests. Okay, so we assume returns follow some kind of known distribution. Doesn't have to be normal. It can be T distribution or any other, distribution from, let's say, extreme value theory, right? So yeah, any kind of distribution that does justice to the actual behavior of returns. If it is, let's say, fat-tailed, then you need to choose a fat-tailed distribution. All right, for our argument, we'll consider normal distribution. Returns follow normal distribution. Okay. So what you need to do is estimate the parameters of that distribution from the return time series. So you have the historical returns with you. If you assume that these returns follow a distribution, they come from some kind of distribution, and that distribution has a defined PDF, a known formula. Normal distribution has a defined PDF, and in that PDF, there are two parameters, mu and sigma. If you can estimate mu and sigma from the history, then you define the full distribution. You just need the mu and sigma to define the entire normal distribution. So that's it. It boils down to estimation of a few parameters that fully specify the distribution. And then you don't need the data anymore. Just the parameters will suffice. I can tell you the density, I can tell you the CDF, I can tell you any quantile that I want. I don't need anything else. I just need the parameters. So that is parametric method. So what we do here is fit a well-behaved distribution on the historical return time series. Popularly, we use normal distribution, and you estimate the parameters that define the PDF of the distribution. In our case, it's just mu and sigma. It's again kind of copy paste, but we are not saying it has the same empirical distribution. We are saying we have assumed a well-known distribution, which is normal distribution. We have figured out the parameters mu and sigma. Now we are saying that tomorrow's return will come from this distribution, normal distribution with parameter mu and sigma, which I have estimated from the past. Okay, so that's parametric approach. Okay, let me know if any questions. I'll move on. And the last one is Monte Carlo simulation. So Monte Carlo simulation is both powerful and expensive. Okay. uh, Ideally for highly nonlinear portfolios, we use Monte Carlo simulation, but it is the most expensive method, consumes a lot of resources. So it is rare in market risk, but if there is significant nonlinearity which cannot be estimated by the other methods, then we use Monte Carlo simulation for that specific portfolio. The approach is something like this. So we assume that the risk factors follow some kind of stochastic process. Stochastic process means they're random variables uh, indexed by time. That means at every point in time in future, it will take a different value. That's what stochastic process is. There's an entire literature behind stochastic process. We don't need to worry about that. For now, we'll assume we're focusing on returns, right? We'll assume returns follow normal distribution. So what you need to do is simulate these risk factors. Simulate these risk factors. Okay. Monica has a great question. Monte Carlo is categorized under non-parametric. Um, that's a very tricky question. So historical method, definitely non-parametric. In Monte Carlo, in order to simulate the risk factors, you need to calibrate the parameters of the stochastic process. So, for example, if you say stock price follows geometric Brownian motion, you still need the mu and sigma. So, that is calibrated looking at history. In value at risk or risk management world, if somebody says parametric method, they typically don't refer to Monte Carlo. It's the second one. But if you ask me, Monte Carlo is parametric or not, strictly speaking, it uses parameters to simulate. Okay, the simulation requires you to have the parameters handy. Only then you can simulate. So yeah, it does require parameters, but historical method is free of parameters. There is no parameters. Okay. So you just have to simulate various paths. So how would you do it? Is something like this. So tomorrow stock price can take various. It can evolve in different ways. So you simulate all possible paths, not all possible, but you take a lot of simulations. And these are the different realizations of the stock price. Okay. So based on that, you come up with the distribution. Okay. It is a simulated distribution. Different possible values it can take. Based on that, you create a histogram. That's the distribution. All right. So these are the three main approaches. And what are we trying to do here? We are just trying to figure out the distribution of tomorrow's return. That's it. All right. I hope this is clear. Okay. What about derivatives? So we talked about just one stock, correct? But our portfolio, trading book portfolio, will consist of numerous different types of instruments. Lots and lots of derivatives would be there. So as we know, derivatives derive their values from the underlier. Okay. Every derivative, V is the value of the derivative, is a function of some underlying risk factor. Okay. It could be one risk factor, it could be multiple risk factors. All right. Now we know how to calculate the PNL of just a single stock. It's just the delta S, correct? How do you obtain PNL for a derivative? Delta V, change in value of the derivative, delta V, that's the PNL. But it is not a simple instrument, it's a derivative. There are two approaches, okay? So either you can use full valuation. So change in value of the derivative is after minus before, okay? So this is the value after the stock price has been shocked minus the original value. So you have to have the valuation right now, And you also need to value the instrument after shocking the risk factor. Okay. And after you have done that exercise, take the difference. That's the PNL. That is called full valuation, because you are repricing the security by using a pricing function or pricing engine. That is one approach, which obviously is expensive because you have to reprice. So you have to invoke the entire pricing engine after shocking the risk factors, which can be costly. Okay. When I say pricing, don't just think of Black-Scholes. Pricing can be very, very costly. There are numerical pricing engines, Monte Carlo, for example, which is expensive. There is finite difference methods. There are binomial, trinomial trees. Uh, there are Fourier transform semi-analytical methods. All kinds of methods are there, right? So they might be costly. So this is full valuation. Obviously, it will give you more accuracy, but at the same time, it is costly. All right. Question from HP: what instruments are available in off-balance sheet from market risk perspective? All the pretty much all the market risk instruments we book under off-balance sheet, because they are um, mark to market, right? So on the balance sheet, you will have everything that is accrued and realized. In mark to market, all derivative positions are typically in off balance sheet. You can think of any kind of derivative. Okay. All derivatives, forwards, futures, FRAs, swaps, options, exotic options. Everything is part of market. So think of trading book portfolio. Primarily, the trading book portfolio, the items are in off balance sheet and they are subject to market risk treatment. On top of that, in banking book, the FX and commodity, again, I'm talking from a regulation perspective, FX and commodity exposures in banking book are also to uh, subject to market risk. There could be derivatives in banking book also for hedging purpose. Okay. All right. So question from Monica: full valuation method is for nonlinear products. Nonlinear products specifically means options, exotic options. All right. How it is different from Monte Carlo, which is also nonlinear? Uh, I didn't get that question. Um, okay, maybe okay. So if I understood this correctly, in Monte Carlo setting, we typically use full valuation. We don't take shortcuts there. All right, and Monte Carlo is used for nonlinear derivatives, highly nonlinear derivatives like options, which are, let's say, path dependent. Okay, not plain European securities. So exotics like Asian options, other types of options. So to calculate market risk for these exotic options, if you can use full valuation, and if the pricing methodology is Monte Carlo, then you can use Monte Carlo with full valuation. I will show that example a little later. Okay, question from Shubham: how is Taylor series used? Okay, I haven't spoken about Taylor series yet. Let me complete that. I'll come back to that. Yes, you can use Taylor series within the historical simulation also for options specifically. I have that example. I'll show you. All right, let's come back. So how do we calculate PNL of a derivative? Full valuation, you have to reprice the secure derivative using some pricing engine, and then calculate the change in value. That's it. So that's the PNL. Or you can use local valuation with the help of sensitivities or Greeks. Okay. Now, how do you get the Greeks or this PNL equation for the local valuation? Is through a very fundamental and powerful tool that we have in quantitative finance. It's used everywhere. It's one of my favorite probably the most favorite tool in all of quant finance. That's called Taylor series expansion. Taylor series expansion gives you a ready-made formula to calculate the change in value of any function. Derivative value is a function. It's a function of underlying risk factor. So delta V is linked to delta S and other things. So we'll talk about that through this Taylor series expansion. And the coefficients are the sensitivities or Greeks. Okay. All right. So through Taylor series expansion, we can write down the PNL equation for any kind of function of an underlier, which are nothing but derivatives. Okay. Now, once you write down the equation, since we know we are fitting a distribution on delta S, not directly through returns, but once you specify the returns, you know the value of delta S. So we know how delta S is distributed. Now, from the distribution of delta S through this sensitivity, which is dV by ds, we can derive the distribution of delta V. Okay, so it's a two-step process. Write down the Taylor series expansion, which is the PNL equation for the derivative. It will have all the Greeks, necessary Greeks multiplied by the necessary changes in the underlier. The equation comes very naturally, right? Now use that equation. Because you have already modeled the change in risk factor, through this equation, you can immediately derive the PNL distribution of the derivative. All right. So that's the idea. So we'll see example on that. Question from Rahul. Taylor series and full evaluation used to generate PNL numbers further to create PNL distribution. Yes. So that further we can able to apply VAR approaches to calculate the VAR number for particular test. Yes, that is absolutely right. Okay. Right now we are focusing on PNL. Okay. So for plain vanilla stock, it's very simple. You can just get the return distribution from using one of the three methods, calculate the new stock price, and calculate the PNL, which is delta S. Easy peasy. For derivatives, which are complex functions of risk factors, there's a two-step process. Either you do full revaluation, that means reprice the derivative. That's it. And take the PNL, or use Taylor series expansion to do a local valuation, and that will be done through these sensitivities or Greeks. Okay, so we'll talk more about that. So you obtain the PNL distribution. Next step, as Rahul pointed out, you got the distribution, PNL distribution. Okay, next thing is to calculate the risk measure from that distribution. How do we do that? So what are we trying to do? From a risk management perspective, we want a conservative estimate of loss. That is what we are trying to prepare for, right? Tomorrow, how much can I lose? You have the distribution. Looking at the distribution, you are going to settle with a number which is representative of a worst case scenario. How bad things can happen tomorrow, right? So, a couple of measures are popular. I would still say the gold standard of risk is value at risk. It is still used everywhere. Maybe not for regulatory capital charge at the moment, but VAR remains the single most important risk measure even today. Okay, for different types of planning. See, regulatory capital calculation is only one aspect, but there is optimization, there are risk settings, risk limits, and all these things. VAR is still being used, not as part of FRTB, any old standard. Basel 2.5 or 3, we are still using value at risk. So value at risk is one such measure. We'll see what that is. And recently in the FRTB framework, we have the advanced approach. For the advanced approach, we're using something called as expected shortfall. So these two are popular risk measures, which you calculate on the distribution that you just arrived at. Okay. Risk measures are used for risk budgeting. We'll see the this use case tomorrow. So I'll walk you through incremental VAR, component VAR, marginal VAR, and some kind of optimization we'll do, portfolio optimization, and obviously regulatory capital charge. So depending on how much risk you have in your portfolio, you have to keep the capital buffer to compensate for that kind of loss. Right. So there is regulatory capital. There is also economic capital. Economic capital, again, both value at risk and expected shortfall are used. It is an internal calculation. Um, so not the regulatory capital charge. Economic capital is your overall planning in terms of, it's actually targeted to, or the economic capital exercise is done to target a particular credit rating. Okay, see, if you have to take risk to generate return, right? How much risk you are willing to take, that defines your credit rating. Okay, if you are giving junk loans or investing in junk bonds, then you have a risky portfolio, your rating would go down. But at the same time, you are generating high yields, high returns, right? So economic capital calculation is done to target a particular credit rating. Regulatory capital is the amount of loss absorbing capital that you need to keep aside, which is your equity capital, right? That's the idea. So we got the P&L distribution. On the right side, there is profit. On the left side, there is loss. We are looking at a conservative loss estimate, because when you want to keep capital, it has to be one number. It cannot be a series of numbers, right? You have to summarize the entire risk in one number. That number could be an extreme quantile on the left hand side, some kind of quantile, let's say 5% from the left, right? Or 1% from the left. So that is called value at risk. Or what you can do is talk about the average loss beyond a certain quantile. So if things go bad, what is the average loss in the bad scenario? So expected shortfall is the average tail loss. All right. So these are the two popular measures of risk. But to find that out, you need the distribution. Either a parametric distribution, which is formula based, then you have formula based or formulas for VAR and ES. It's just formulas. If this distribution is not formula based, like it's not normal or anything, it's empirical. So there are a range of values that you have copy pasted or simulated. Then you have to take the quantile and calculate the actual average on those numbers. There is no formula. Formula in the sense there is formula for average, but it's not linked to any parameters. Hope that makes sense. So yeah, we went from risk factor modeling to P&L equation to P&L distribution to risk measure. This is the whole story of market risk. After this, we have backtesting and validation that will be covered tomorrow. But overall, this is the flow. Okay. The next one is something very important, which is called risk factor mapping or aggregation. So before we look at this particular topic, I want to give you a very simple analogy, which perfectly fits what we are trying to do in market risk. It's exactly the same. Okay, so hear me out. As a human being, we consume all kinds of food and beverages every day on a daily basis, right? Every there's a question: is the Basel document which we can refer for model validation? There is a SR11 7, which is the model validation guidelines. I'll briefly show that tomorrow. Specific to market risk, with IMA, which is the advanced approach, we have backtesting requirements, and PNL attribution that is given in the document. Yeah, I'll explain all of those tomorrow. Don't worry, it's just one more day. Okay, come back. So, risk factor mapping and aggregation. Now, consider as a human being, we consume all kinds of food and beverage items. Every food or beverage item is can be seen as a bundle of few important ingredients, which is fat, carbs, protein, cholesterol, etc. Okay, so this is clear, right? I hope when you consume something, you look at the nutrition facts, and behind every packaged food, they disclose all this information, right? So that's what we consume. Now, as we consume all of these constituents accumulate, so they get added up. Okay, fat comes from that one item, another item, the total fat gets added up. Carbs added up, right? So keep that thought process. You'll see the parallels. Yeah. Now, to maintain a healthy life, sorry for the typo, we need to balance these levels or limit our exposure to fat, carbs, etc., etc. We hear that all the time, but we ignore that all the time as well. Just kidding. So, so we are good till this point. Now, some of these factors, which is fat, carb, protein, are broad, and some are more granular, right? When you say fat, carbs, or sugar, then protein, cholesterol, these are broad factors that must be disclosed behind the packaged food item. But other than that, there could be other small things like saturated fat, unsaturated fat, sodium, potassium, other kinds of things. Those things, you never look at potassium, right? How much potassium I'm getting from the packaged food. But those factors are there, but they are secondary or more granular, if you want to call that. And the overall contribution, it is mentioned in big bold letters, which is calories. Do you agree with all of these? We have all seen this. Okay. Now, some pictures. So let's say you consume one Coca-Cola bottle, and these are the contributions: fat, sodium, carbohydrate, protein, and you have a delicious burger that also has these ingredients. So what will happen is, after you consume these two, food and beverage, um, overall you will have some fat, protein, and carb intake that day. Whoops. And then you have some one single number for the total calories. So 100 calories from the beverage and around 550 calories from the burger, and you have what, 650 calories consumed. Okay, why are we doing this? Do you see where I'm going with this? Exactly similar. Market risk aggregation, risk factor mapping, aggregation is exactly the same stuff. Let's do this. Actually, before going to the next slide, let me tell you the parallel, right? Human being is the trading book portfolio. All these food and beverage items are instruments. Every food and beverage item is a bundle of different ingredients, right? Fat, carb, protein. Every financial instrument is a bundle of risk factors. Fat, carbs, proteins are factors here, nutritional factors. In our case, it will be interest rate, FX rate, commodity prices, equity prices. That those would be the risk factors. Every instrument is a bundle of those risk factors. And human being is the trading book portfolio. Trading book portfolio has lots of instruments, just like human being eats lots of food, right? And at the end of the day, they all get added up in their own lanes. Fat gets added to fat, protein gets added to protein, carb gets added to carb. Similarly, in risk factors, specific, so exposure to a specific risk factor All the different exposures for a specific risk factor will get added up. We call that as a net sensitivity. Okay, so we'll see that. So that's what the that's what there is. And then finally, one single number that kind of summarizes what is your overall intake or exposure. That is calories in this world, and we have value at risk in market risk. A single number that tells you how much you can lose, a dollar value. Okay, exact same setup. So let me walk you through that. In trading portfolio, there are many instruments, which are our food and beverage items. Each instrument is mapped to risk factors. And we develop the P&L equation for each instrument, obtain the portfolio P&L as sum of instrument level P&Ls. Okay, change in value of every instrument, if you add, you get the overall P&L of the portfolio. So, and then you get the distribution of the portfolio P&L, estimate the risk measure. That is these are the steps. So here we have some instruments, V1, V2, V3 up to Vn. Then we have some risk factors, S1, S2, S3 up to Sk. K is not same as N. Okay, number of instruments is N, number of risk factors is K. They don't have to be the same. Can you tell me in real life which is more, or which can be more typically? Instruments will be more or risk factors will be more? Oh, okay. Well, I'm getting mixed responses. If you have a large trading book portfolio, you have a big investment bank, the number of instruments would be larger. Think like this. For the same risk factor, let's say IBM stock, you can have stocks, you can have options, call options, put options, other type of securities, but they all refer to the same risk factor. Okay, so instruments get mapped to risk factors. Typically, one instrument is mapped to multiple risk factors. I'm not saying that, well, in a book, if there is a risk factor, it must be coming or tied to some kind of instrument that you're modeling, right? Typically, your instruments will be larger. Number of instruments will be larger because one instrument can refer to is a bundle of multiple risk factors. So think from a food and beverage perspective, right? There are only four factors: fat, protein, cholesterol, and carbs. But how many types of food and beverage exist that consist of the same four factors that we consume, right? Exactly similar. Okay, so when it comes to risk factor mapping, we map every instrument to risk factors. One risk factor or multiple risk factors, depending on which risk factors are responsible for the price change of that instrument. Okay, so there is a theoretical understanding. Okay, these are the risk factors that influence my security. That's fine. Second step would be, are you able to model those risk factors? Do you have enough data, or is just a theory? In market risk, the set of risk factors typically is much lesser than what is used in front office, who are responsible for pricing the derivative. Okay, because we have a separate use case. In market risk, we are trying to take the time series of risk factor returns, come up with a distribution, and then use the distribution to explain the P&L of the instruments, calculate value at risk, blah, 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 blah. That use case is different from pricing requirement. Okay, so we normally take shortcuts. For example, it is possible that the entire US domestic equity portfolio is mapped to only one risk factor, which is the S&P 500 index. So we are saying that the S&P 500 index moves, everything moves, and that is the only single risk factor. All the instruments are linked to that S&P 500 index, through their, let's say, beta sensitivities. But it is one risk factor. It is possible. Okay, it is also used in practice. So yeah, we have instruments, we have risk factors, and there is a mapping. This is called risk factor mapping. And then the next step would be, once you conclude the mapping step, now we are talking about risk factor changes. Tomorrow, the risk factor, so today the risk factor is S1, S2, S3 up to SK. These are the values. Tomorrow, the risk factors will change. The change is delta S1, delta S2, delta S3 up to delta SK. Okay. How do we model the change? By fitting a distribution to the on the returns. Now, if return is, whether it's an absolute scale or relative scale, you take care of that. Okay. But it's very easy to figure out the change. Once you model the returns, you can always model the absolute changes. So we fit a distribution on these changes, as we talked about. Three different approaches, right? Historical, parametric, Monte Carlo. Now, from there, we figure out what is the change in the value of these instruments. We have the mapping in place. We need some kind of a linking mechanism, and that linking mechanism is nothing but Taylor series expansion and PNL equation that we write using Taylor series expansion through these sensitivities, or Greeks as we call it. The change on the risk factor will propagate and influence the instruments, and you have the PNL of the instruments. Okay. And the return distribution also manifests, or you can figure out the PNL distribution from the return distribution through these sensitivities or Greeks. For that, you need to do a little bit of algebra. So I will explain that. All right. And once you have the PNL distribution, you can calculate the risk measure, whether value at risk or expected shortfall, that is up to you. Question from COVID, how can this be true? Some desks use pre-deal VAR before entering the trade. Yes, so that's correct. So that discussion we'll do tomorrow. Marginal VAR, component VAR, and which trades are profitable, and all that trade-off discussion we'll do tomorrow. I'm simulating value at risk before the trade. Shouldn't the risk factors be the same as pricing? No. Pricing engine might be very, very complicated. Value at risk calculation, we are at the liberty to take shortcuts. It is highly possible. Okay, we are not, so in the back office, right, we do not use the same set of risk factors that are used in front office. Okay, so we use shortcuts. It will be a reduced set of risk factors. Only those, think of broad market risk factors which are responsible for price change. We do not have to go after each and every penny, that it has to be accurate, because that comes with a cost. Okay, and because we also have different modeling requirements. We need to ensure the risk factor has enough data, because we are imposing a distribution on top of that, right? So it has to have enough prices. It has to be modelable, and it doesn't have to be the same as the factors that we use for pricing. Okay, this is as a general rule. Okay, so for risk management, we typically use a reduced set of risk factors. All right. So summarizing whatever we have discussed so far. One moment. Okay, so the summary is, so far is, we map the instruments to risk factors, obtain the PNL equation for change in value of the instrument to the risk factor returns using Taylor series expansion. Then we fit a distribution on the risk factors. And because of this equation in place, we can obtain the P&L distribution for the instruments and portfolio. And from the P&L distribution, we can calculate the risk measure. Now, when you do market risk calculation, typically you have this like large trading book portfolio, which is a function of many types of risk factors. See, risk factor is something that can induce a change in the value. Okay. From a market risk perspective, we are focusing on very specific risk factors, which are basically, we can say, market prices, equity risk factors, FX, interest rate risk, and commodity. So these four, at a very high level, together are part of this study. So when equity factors, FX factors, interest rate factors, and commodity factors change, what is the impact on the trading book portfolio? That is part of the market risk calculation. Everything outside of this, for example, risk of, let's say, uh, default. Well, default in trading book is also part of market risk, but I'm just saying default is a feature of credit risk. But at a high level, these are the primary market risk factors that we are concerned with. As I said, in the second workshop, we'll do a detailed regulatory treatment. So right now, we are not going by any regulation as such. All right. So this is the overall idea. Okay. Question from Rahul. Credit spread changes is part of. Yes. So there are multiple regulations that treat this in different ways. So you can say credit spread is the specific part of interest rate. Okay. But in FRTB, it's a separate, within market, it's a separate asset class, CSR, credit spread risk. There is a question, how can you explain how to fit a distribution on risk factors? Yeah, we'll go through the example, so that will make things clear. All right, so we are ready to look at a end-to-end example for all these calculations. What's the time now? 9, 10. Okay. Awesome. So let me pause the recording here. And do you guys want a break or we can continue?